Hi everyone, welcome to the channel. And today I'm announcing a new playlist in which we will be discussing the complete transition from LIBOR to SOFR, which is quite important if you are working as a quant. So basically, as we already know that we have transitioned from LIBOR to SOFR, and you need to understand the underlying reasons, what LIBOR was, what is SOFR, right, and basically the multi-curve framework that used to be there. First of all, the single curve framework was there, then multi-curve came, and then we will be discussing the questions like are we again going to shift to the single curve framework? Okay. Before that, we will be discussing LIBOR and SOFR in detail, the differences between the LIBOR and SOFR, what led to the transition. And another important question is, uh, we will be downloading the SOFR data in the later playlist, in the later part of the playlist, where we will be downloading the SOFR data, and we'll be trying to. They already provide the, so basically Federal Reserve of USA provide the calculation methodology, and we'll be trying to mimic that by ourselves. So it's gonna be quite interesting series. You will be understanding everything in quite detail. So let's start this section first, okay? And let's understand what LIBOR is. And and one important thing is that this session will be quite interesting, because sometimes you might not understand what LIBOR is, because the way they are explained in the book or internet might be quite confusing. But I have tried to explain it in quite detail, and in a way that will seem quite intuitive to you. Okay, so first of all, what LIBOR is? Okay, so it's like London Interbank Offered Rate. It's full form. So let us not dive deep into it, but let us try to understand what LIBOR is. Okay, so when you talk about different interest rate, right? Interest rate can be anything. For example, I and you can enter into a transaction, right? And for example, you gave me 100 rupees, and you are saying that return 100 rupees along with some interest rate after 1 year. Okay, let that interest rate be R. Some another person may also enter into transaction, and their interest rate may be different. Let us say that be R1. Okay, so but industry needs a benchmark, right? For example, there are many interest rate derivatives that are referenced through some benchmark. For example, SOP, right, where one leg is fixed and another leg is floating, but it is linked to some reference rate in the world, right? So for example, what that reference rate may be, for example, repo rate, it is also a reference rate. In India, repo rate is something, right? So what that reference rate should be? So LIBOR was one of those kind of reference rate. Okay, so before we discuss what LIBOR is, I will be attaching a screenshot about the birth of LIBOR. Okay, and if you read this slide, you will understand that LIBOR wasn't intended to become a benchmark for the entire market. So basically, JP, it was from Josh Younger, interest rate derivatives researcher in at JP Morgan. So basically, he says that it started out. So basically, LIBOR started out because a group of banks wanted to lend money to overseas client back in the 60s, and no one had ever done a floating rate loan before. Okay, so what he means is that this kind of this framework of interest rate, this LIBOR was started because a group of banks wanted to lend money to overseas client. Okay, now see this one. So this basically, if you read this portion, you will realize that uh, this was about the first deal of LIBOR. Okay, so now let me explain you what LIBOR is. Okay, so what happens is that uh, every day at 11 a.m. UK time, 18 global banks used to submit their estimated borrowing rates. Okay, what does it mean? So it means that these are 18 banks, and they were asked one question. What that question was? At what rate could you borrow funds? Were you to do so by asking for and then accepting interbank offer in a reasonable market size just prior to 11 GMT? Okay, it means that if these 18 banks wanted to do a transaction or wanted to borrow or lend fund, at what rate can they do so? Okay, so see, it depends. So basically, there are two sides of it. First of all, there are actual transaction happening, and there are interest rates involved. They can give this data to the IC. Basically, Intercontinental Exchange was the administrator of LIBOR. They used to calculate the LIBOR rate after getting the data from these 18 banks. Now these 18 banks used to give the data to ICE by either giving the data by considering two facts: by considering the actual transaction that used to happen. Second thing is that by making a proper guess based on the actual data. So at what rate could they borrow fund if they wanted to do so, okay, or if the actual transaction is already happened, it is good. So LIBOR was not perfectly based on the actual transactions, okay. So if they have actually transacted using some interest rate, using certain quote of interest rate, then they can give this data. But that data was also included, uh, which was like, if they wanted to borrow fund, at what rate could they do so, okay. So if you see, 18 global banks used to submit their estimated borrowing rates daily at 11 a.m. UK time for each currency and tenor. So basically, the data was for how much time they wanted to borrow fund. So basically, it was overnight, 1 week, 1 month, 2 months, 3 months, 6 months, and 12 months. So basically, for these maturities, they had to give data in two parts. Basically, they had to give data, but this data was not completely on transaction based. This data was also based on the estimated guess, right? So the four highest and the four lowest quotes were discarded out of these 18, and the average of the remaining 10 quotes gave the daily LIBOR rate, okay. And this daily LIBOR rate was for different maturities, like overnight. For example, uh, overnight maturity means if you want to borrow fund for overnight, then you can check the overnight LIBOR rate. This will be the rate that you need to at which you need to at which you can borrow funds, right? And then 1 week, and 1 month, 2 months, 3 months, 6 months, and 12 months. These were the maturity, and these are the five currencies for which LIBOR rates were quoted. So LIBOR is the interest rate at which major global banks estimate they can borrow unsecured short-term funds from other bank in the London interbank market. Now I think I have explained LIBOR in detail, but there is an important term which is the unsecured. So basically, the estimation that they used to give was on unsecured funding, okay, unsecured borrowing or unsecured lending. So these lendings were not backed by anything. So there were no collateral. These all were unsecured, okay. So if I were to brief LIBOR in 1 or 2 points. First of all, 18 global banks were there. They used to submit their data daily at 11 a.m. UK time. Now what they used to do is that they had to submit data for five currencies, and these I think 5 to 7 maturities, right? So five currencies and 7 maturities. For each of these currencies and maturity, they had to give data like if they wanted to. So they had to answer one simple question: at what rate could they borrow fund, okay. So it was based on, so basically these banks had to give the data to the ICE based on their estimation. These estimations should be backed by, first of all, transaction that actually did, right? Transaction that they actually did. And the second one, this should be backed by some estimated guess, proper guess, right? I have already explained this. Now, what was the issue behind this particular calculation of LIBOR, right? So basically, LIBOR was based on judgment, not actual transactions. So as I already explained, so let me explain you again. So basically, let us say there are 100 participating banks, okay, and they are doing transactions for these maturities, like bank number 1 and bank number 40. They want to transact overnight. They settled on some interest rate. This can be a good proxy for overnight interest rate. This overnight interest rate data can be taken by all other 100 participating banks. Similar thing goes for other maturities, right? So if all these things are transaction backed, then this gives you a kind of assurance that the rates are calculated correctly. But LIBOR was not entirely based on the actual transaction. There was some kind of, so the data that these banks used to submit was based on partially actual transaction and then some based on judgment, right? So over time, what happened is that interbank lending volume declined drastically, especially after the 2008 financial crisis. Now, why did it happen? Because LIBOR was unsecured, right? LIBOR was based on unsecured transactions. So after 2008, banks started worrying about their credit risk of each other, right? So the unsecured transactions started becoming quite less. The volume started declining drastically, right? That's why now the data that these 18 banks used to submit was now based on guesses rather than actual deals, because the number of actual deals declined drastically. So they were basically guessing or were deliberately choosing numbers, right? So basically the numbers that they were now submitting to the eyes was kind of choosing numbers to benefit themselves. So these started happening because the actual number of unsecured transactions started declining, right? Now what happened to make things worse? What started happening is that traders within these banks, basically these banks that which used to submit the data, they started, uh, you know, asking the LIBOR submitters to submit higher or lower rate depending upon their trading positions. So they started submitting the data which will benefit their trading positions, right? So for example, if a trader is holding a derivative that will pay more when the LIBOR is low, then these submitters, they will be asking submitter to quote to say lower data for LIBOR, right? So basically during the 2008 crisis, banks manipulated submission to appear healthier than they were. Submitting a lower borrowing rate made a bank look more credit worthy even when it wasn't. So basically, they will be submitting lower rate just to say that, see, we are borrowing at a lower cost. That means we are more credit worthy. So it became more of a kind of a manipulation technique. Okay. So if you are more into interested about it, I will quote some incident or basically criminal charges that happened. Basically, in 2012, several major global banks, including, for example, Barclays was the first major bank that was charged. They were put around penalty of $453 million. Basically, what happened is that banks were submitting false interest rate data to benefit their trading positions, right? Even UBS of Switzerland, Royal Bank of Scotland, right? All these banks were charged because of manipulating their submissions to appear healthier than they were, right? So, and as I already explained, you can also go through what I said. Basically, these all criminal charges. Again, to explain what was the reason, what were the reasons behind the transition. The first thing was that LIBOR was based on the unsecured transaction between the banks, right? But after 2008, unsecured borrowing transaction between banks declined. So it reduced the size of the underlying market feeding into the LIBOR submissions, right? So basically the LIBOR submissions had to be backed by data, but nowadays because the transactions that were unsecured were happening quite less, that's why more of guesswork was happening rather than the actual transaction, right? Now, and another thing happened is that LIBOR credibility was questioned. The reason behind that was that 198 trillions of worth of contract was happening around LIBOR. So basically, all those interest rate derivatives that you can think of, there are loans, there are mortgages, all those things, right? All those things which were referenced to LIBOR were worth of around 198 trillion contracts, right? And the banks that were submitting the LIBOR data, the transactions of which were only of $500 million, right? So the LIBOR was being decided based on transactions of $500 million and some of more of guesswork. Okay, and the market that was basically dependent on LIBOR was around 198 trillion of worth of contract. So you can see the kind of manipulation or the kind of problem, scale of problem that happened because of the 2008 crisis, right? So SOFR, with its large range of observational transaction, is a more robust, measurable, and reliable benchmark, right? So now LIBOR had. So basically, what I'm saying is that SOFR, which is, I will be explaining what SOFR is. It became a kind of a more robust, measurable, and reliable benchmark rather than LIBOR. The reason behind this is that, first of all, SOFR is based on actual transactions rather than the guesswork. So the data that these banks quote is now based on actual transaction that is happening, right? And again, based on secured transaction rather than unsecured. Okay, so SOFR is kind of a risk-free rate. So the ARRC, under the Federal Reserve guidance, selected SOFR as the new risk-free benchmarks for USD market, and similarly for other market there were other like Sonia and all. A paged transition plan was released in 2017 to guide and encourage SOFR adoption across the financial system. The secured overnight financing rate, which is SOFR, is a broad measure of cost of borrowing cash overnight collateralized by treasury security. Now see, this term secured is important. So now what happens is that there are multiple banks, okay? They submit their data to Federal Reserve basically. but the data they submit now are basically the actual transaction that they did for overnight transactions. Okay, so for example, bank A and bank B, they want to lend or borrow overnight. At what rate they could do so? They have to submit this data to Fed. But this lending that or borrowing that is happening uh, should be collateralized. So basically, they submit only collateralized transactions. Okay, so that is one benefit with SOFR, right? So now this is one of the difference between the LIBOR and SOFR. So basically the LIBOR, data that was in the LIBOR, if the LIBOR that was calculated by ICE, the data that was submitted were based on unsecured transactions, right? But the SOFR is based on secured transaction. LIBOR was based for various maturities. For example, I explained, right? Overnight, 1 week, 1 month, 2 months, 6 months, 12 months, and all. But the SOFR is based on transaction overnight only. Okay, so the last night, at what rate could you borrow funds, and basically based on the secured transaction, right? In the LIBOR, because it was based on unsecured transaction, the LIBOR used to incorporate the credit risk, right? But SOFR, because it is based on secure transaction, it does not incorporate the credit risk. So you need to add a spread to SOFR to incorporate this credit risk. So LIBOR was partially based on the transactions, and some part of guesswork was also there based on the panel submission of the banks. SOFR is wholly transaction based, okay? And this fifth data, it is not accurate. Basically, if I have to give the accurate data for it, it's kind of so basically the 3 month LIBOR, okay? So if you're talking about the 3 month LIBOR transaction, it were having a transaction of $1 billion transaction, right? But so far is having a transaction of 1 trillion underlying transaction, okay? So as I explained in this slide, if you see, this is the transaction, right? This is the transaction that I was talking, sorry, this is the transaction that I was talking about, right? The 500 million market activities. So basically LIBOR was based on this much of market activities. So LIBOR was decided based on this much of market activities. But currently the updated data is around $1 billion, but the SOFR is based on the transaction of 1 trillion underlying transaction, right? So this updated data should be around 1 trillion. So you can see the scale at which SOFR is, kind of based on. So the data that is SOFR is decided based on huge number of transactions, right? Rather than LIBOR, which was only decided based on the $1 billion transaction, underlying transaction, right? Again, what is the to add some of the differences between LIBOR and SOFR? LIBOR is a daily average of what banks say they would have to pay to borrow the another bank for various term, 1 month, 3 month, and all, etc, etc. The rate is forward looking. Why? So this is one of the major difference between LIBOR and SOFR. LIBOR is forward looking because say, let us say I and you enter into transaction, right? And what we are saying is that if I want to borrow now for 3 months, right? And what rate should I pay to you for this 3 month transaction, right? So this is kind of what will be the interest rate for the 3 months in the future, right? That is the rate that I will be paying to you, and this is the rate that I will be submitting to the ICE. So this was LIBOR, so this was forward looking. But now talking about the SOFR, what I will be submitting is that last night I had a transaction of this much amount, right, at this rate. So this is kind of backward looking. So basically LIBOR is forward looking and SOFR is backward looking. And as I already have explained it in quite detail, LIBOR is kind of based on LIBOR was based on unsecured transaction, but SOFR was based on secured transaction, backed by treasuries. A few important aspects that I will be covering in the next lectures will be how to calibrate SOFR curves. Basically, I will be showing you how to find 30 days, 60 days, 90 days moving average from the SOFR data, how to calibrate the term SOFR, SOFR futures and all. So I'll be explaining SOFR futures and everything in detail. If you have any questions related to this particular topic regarding the difference between LIBOR and SOFR, you are free to ask. Now, why is it important? Because you might have heard about interest rate swap, swaption, caps, floors, anything. Even the interest, even the loans that you take, anything, they all are based on the benchmark interest rate, right? So LIBOR was one of the benchmark interest rate that was discontinued. So I think the last LIBOR rate that was published was around June of 2023, right? So there was a phased ARCC made a phased plan for the discontinuation of LIBOR, and SOFR was chosen as the benchmark interest rate. So now all the swaps and all other transactions, interest rate transactions, will be benchmarked or referenced with SOFR, right? So that is it. I had tried to explain the differences between the LIBOR and SOFR. What was the problem? So if I just repeat what was the problem was that LIBOR was based on actually partially transaction based and partially kind of their judgment of what will be the rate they will be charged if they had to borrow unsecured transactions for some certain maturities, for overnight, for 1 month, 2 month, 3 month, and all, right? Okay, so the banks, these 18 banks used to submit their data based on these certain transactions and certain their judgment, right? So now after the 2008 crisis, what happened is that the number of unsecured transactions uh, started decreasing quite drastically, right? So the data that these banks you were submitting were now based on their judgment, right? And kind of they started manipulating the market. They were submitting codes, they were submitting the data which could benefit them, right? That's why LIBOR, and again the number of unsecured transactions have started declining, right? So LIBOR was based on the unsecured transactions. So, and you see, there are certain transactions from which LIBOR rate is basically carved out, from which LIBOR rate is extracted, and then this LIBOR rate particularly will be used to reference all other interest rate products in the market. But this particular transaction from which LIBOR was carved out was quite less, right, after 2008 crisis. So you can imagine the kind of problem that were there. So that's why, first of all, they moved from the unsecured to secured transaction. This is first. Second thing is that they moved from uh, get, they moved from actual transaction plus judgment to actual transactions only. That led to basically from forward looking to backward looking, right? So in the next lecture I will be explaining you, uh, in the next few lectures of the playlist I will be explaining you uh, how all this, so basically how to uh, you know take the data from the Fed for reserve, Fed fund reserve, and basically find out 30-day average, 60-day average, 90-day average, right? Find out what how to calculate the SOFR index, then basically how to calibrate to the SOFR terms, what are SOFR futures, how can we reference you know future rates from the SOFR futures, and all everything in detail. It will certainly help you in your interviews if you uh, want to appear for any quant trading, quant research, quant pricing analyst interview and all, right? So if you have any question, just comment it down and I will be taking up it up. Thank you.